in the past year by some very profound, unexpected changes. I think you hear a lot of people talk about creative destruction these days, and I actually can't recall a time where we have had so many shocks to our economy. As you know, almost exactly a year ago, OPEC changed its strategy, and instead of focusing on oil prices, launched a war for market share directed specifically at US shale producers, but also at Canadian oil sands producers. New governments were elected in Edmonton and Ottawa, and they have new policy priorities. Specifically, they are very focused on the environment, and previous priorities that had to do with increasing energy exports, well, those seem to be have been set aside. We saw the Keystone XL pipeline being rejected, and the Northern Gateway pipeline was pushed to the sidelines by a new tanker ban on the northern coast of BC. And to top it off, the world is now working on a climate change deal that could determine new winners and losers. And there's a final shoe to drop. By the end of the year, we're going to find out what new royalty changes are going to look like. And we know it's going to be a big policy. And again, there's going to be winners and losers. And so our experts here are going to help us look forward and hopefully we get some perspective on what oil prices could be going, the Canadian dollar, the broader economy. Joining us today is Brian Newmarch, who joined Seven Generations Energy in November 2014. He is now the Director of Capital Markets, where he's responsible for investor relations, treasury, and risk management. Brian started his career as a treasury analyst at ARC Resources before moving to RBC Capital Markets to take on a foreign exchange sales role, trading currency with mid-sized Canadian energy companies. Brian then went on to ultimately run the Canadian energy marketing franchise at Citibank before joining Credit Suisse to run the Canadian energy marketing and origination business. He is a U of C grad and a CFA charter holder. We also have Ranko Berich, who joins us from London. That's the one across the pond, where he is the head of market analysis at Monex Europe, and which is one of the world's leading commercial foreign exchange specialists. He is a respected macroeconomic commentator, combining market insight with a deep understanding of global economic and political events. His analysis appears regularly in national and international news, including the Financial Times, The Guardian, and the BBC. Jennifer Winter is also a very sharp commentator on energy issues. She is an assistant professor and associate director for energy and the environment at the U of C School of Public Policy. She has a PhD in economics from the University of Calgary, and her research focuses on energy policy, environmental policy, natural resource development, public finance, and the environmental consequences of resource development. Finally, we have Tim Pickering, who is the president and lead portfolio manager at Auspice Capital Partners. He is the man behind the Canadian Crude Index, a benchmark that tracks and reflects the nuances of the Canadian crude market. Prior to forming Auspice, Tim was VP of Options Trading at Shell Trading for North America. Tim began his career at TD Securities in Toronto in their trading development program, where he worked in risk management and energy derivatives, and the energy derivatives portfolio. So I'm going to start asking some questions, but we're trying to keep it as informal as possible, so feel free to just raise your hand and ask questions along the way. So let's talk about the outlook for oil prices. It's top of mind everywhere in this community. We have a big OPEC meeting coming out on Friday, lots of analysis on it. Most people expect OPEC basically to do nothing, even though some of the weaker members are literally on their knees because they're losing so much money. So, Tim, what's your view? What's OPEC likely to do on Friday?
Well, okay, I'll preface this by saying a couple things. So in terms of how we look at the markets, we're a global macro manager. We trade everything from cotton to crude. We are agnostic in terms of market direction. I don't care if crude goes up or down. I want to make money either way. That's a responsibility we have for our clients. Having said all of that, I have one of the bigger bets in the room in that I launched the Canadian Crude Etf earlier this year, meaning that's a way for Joe Blow or anybody else to make an investment in what is Canadian crude, bottom line being a WCS derivative. That's a long-only product, so I want people to buy it. So my bet's on it going up at some point. We think the downside is definitely limited versus the upside. I mean, when you're talking about Canadian crude, I think our index CCI closed at 28 and change yesterday US a barrel. The downside, we believe, for the marginal barrel here in Alberta is, you know, $10, where the upside is 30 or 40 or so. So long term, we have a positive view. When it comes down to OPEC, I mean, I guess there's an overriding influence there, and we talk about it ad nauseum. But I think what Canadian producers should focus more on, and market participants, is really how to get the best price for our crude here produced in Western Canada and Alberta. We are obviously restricted, as everybody knows in this room. I think we're very beholden to the US, and we need to find ways to get, one, the actual physical barrel, the actual logistic barrel to other markets. But just as importantly, and this is super important from a market access standpoint, there's no market in history that has been successful long term without a combination of physical wholesale participants as well as non-physical financial speculator, not tied to the industry participants. And this market is missing that. And so I think those are the bigger issues than OPEC affecting the price of oil here. Yes, there's an overriding aspect to it, but if I'm a producer here, I want the best price for my Canadian crude. And at the end of the day, I think for a bunch of reasons, we're getting squeezed by Big Brother that we've been too reliant on for far too long. And Keystone is just one of those examples of just BS at play.
So what are some of the factors that could contribute to oil prices increasing then, since you have a
well, I think we need the physical access. I mean, there's no doubt about that. But that's not going to get turned on tomorrow. We can only send so many rail cars out of Western Canada. So what we need is awareness for this marketplace. I mean, we're the third largest reserve in the world. Yet if I go to New York or Dubai or you know, as Brian and I were talking about in Asia, a lot of places don't even know what our market is. Actually, Asia is probably one of those exceptions. They're keenly aware of this, but in a lot of places in general, they don't know. So we need awareness, we need market access, and it's beyond the physical barrel, it's beyond the physical trading. You know, if we look at oil trading, and perhaps there's some oil traders in the room, and I was with Shell, so know the space fairly well. This is a wholesale, physical, old boys club trading market, which is bullshit. It's got to be broken down. We need more participants in the marketplace, whether it's hedge funds, ETF managers like ourselves, whether it's the sovereign wealth funds of the Middle East or big money players from Hong Kong. We need more participation in this market for this market to rise beyond being beholden to the United States, because that's where we are right now.
Right.
I mean, we are, you know, you go to the US, and I don't want to dominate this, but you go to the US, and all you hear is Saudi Arabia, Saudi Arabia, Saudi Arabia. Okay, give your head a shake. We are the #1 importer of US to the United States. We are 2 times Saudi Arabia. Quit talking about Saudi Arabia. We're what matters. And we need to find ways to make that known, so that access not only physically, but financially. And so it's something we obviously are very passionate about. And again, I'm not a producer, so I don't have a barrel in the game. But we believe that this is one of the things that, as an Albertan, was the right thing to do, as a Canadian was the right thing to do. And, you know, so we can talk about OPEC ad nauseum, but at the end of the day, OPEC is going to do what they're going to do. Their motivations are different. Why are they selling so much oil right now? Well, they've got a lot of conflict in the Middle East. They're going to sell as much as they can to fund conflict as well. Don't forget that. So we can speculate all we want, but at the end of the day, what do we care about? The best price for our oil right here. That's what matters.
Okay. Ranko, what's your take?
Well, I think, first of all, I think I will talk about OPEC, maybe not
Okay.
ad nauseum. But sitting in London, I think it's been very interesting seeing the, maybe it's not an exaggeration to call it a fight, because really OPEC's strategy over the last year does seem to have been very deliberately targeted at North American shale production. And I suppose to paraphrase the strategy, it's if they're willing to tolerate prices around $60 a barrel or lower for a year or two, the idea is that they would shake out investment in North American shale, and in the long run, they would face more favourable conditions. Now, I think the last year, I made probably two observations about that strategy and how successful it's been. The first one would be that it's been too successful. I think $40 a barrel was not what the Saudis had in mind. So it's gone a little bit too far now. There's a lot of talk that over the coming sort of quarters, OPEC will attempt to tone back their message of unconditional increases in production. And I think the second sort of major interesting development has been that although North American production has been affected, it hasn't been affected quite as severely as perhaps you would have expected, and that actually $60 a barrel is not lights off for shale in North America. And I think the implications of that is OPEC's sort of favoured scenario where crude goes back up 70, 80, and they get the lion's share of the market. I think that's sort of evaporating. And I don't see infinite sort of production increases from OPEC as being sustainable over the medium term. And I think it's important to know, yes, Saudi Arabia will produce all the oil you want at $12 a barrel, but that's not their true break-even point. It may be the production break-even point, but fiscal break-even points are a lot higher than that. And as Tim mentioned, they're dealing with conflict, they're dealing with social unrest, and so I think potentially we could see a moderation of OPEC strategy over the next 12 months or so. So it's particularly interesting when you think of what's going to happen to completions in North America. Will they start to pick up like we saw sort of earlier this year? So yeah, I think there is a ceiling for crude somewhere, and I think it's a lot lower than OPEC was hoping, because I think sort of a rally above $60, $70, and it will be very interesting to get the opinions of the room on this, does invite production in North America to begin ramping up again.
Okay. But nothing on Friday.
I think maybe jawboning on Friday with the Mario Draghi. We had that report from a couple of Saudi sources a week ago saying that they're willing to work with other suppliers to stabilize prices, and what that means, we don't know. The truth is in the production figures. But as we've seen, with how responsive you would think oil would be fundamentally driven. It's not, it's a financialized commodity. And we know financialized commodities respond incredibly to sentiment. So yeah, we'll see on Friday.
Okay. So Ryan, big picture, has the role of OPEC basically waned? Is the market taking its focus away from what these people do and focusing a lot more on drilling numbers in the United States?
Yeah, that's a good question and kind of a good perspective on things. But I just point out that how many times we said OPEC in the last half hour here, right?
Yeah.
Like OPEC still matters. They produce about 30% of the global oil supply. So what they do is going to impact the market. I think more importantly, they kind of drive market sentiment. Tim spent time on trading desks, I've spent time on trading desks. The speculators out there are taking their cues from OPEC, right? If you want to express a view, whether you're punting around WTI futures or investing in one of Tim's ETFs, you need to know what OPEC's doing, what they're thinking, and how they're kind of balancing the market with the incremental supply. So that being said, like I think it's underappreciated at the time just how tight the market is potentially. You know, we've seen we spent about the last year about 2 million barrels oversupplied. Demand growth has been about 1.5 million barrels higher year over year. So we're kind of over the next year probably oversupplied by about 500,000 barrels. What happens if OPEC all of a sudden goes, you know what, let's cut 500,000 barrels from the market, or even 1 million? Or what happens if something goes off in the Middle East and we lose 1 million barrels like that? We're balanced pretty closely and starting to eat into some of the inventories that we've seen build up over the last year here, and price will appreciate.
Can I just add to that? So, you know, if you look at the supply-demand equation, and, you know, currently we're in an oversupply situation, just for all the reasons that you both have described. That is a lot better than a lack of demand situation. I know that's a really simple economics 101 type point, but as I look at the demand side of the equation on a global basis, China's now the #1 importer of crude in the world. Just came back from Asia to go look for myself. It's fantastic. I mean, and whether it's 7% growth or 4% growth, give your head a shake. It's massive. The absolute number is massive. So the demand side is there. As long as the demand side is there, that's better than you know, that we're in an oversupply situation. Because what happens in oversupply? Well, it whips back the other way. Baker Hughes rig count is at a 13.5-year low. So it's going to come back in balance, and whether it's an OPEC's a factor, production in North America is a factor, pricing's a factor, but the long-term global demand is there, right? So it's really about how do you run your business, and how do you survive these times, and how do you profit in these times? How do you invest in these times? If you got a great balance sheet, what a great time. So, you know, it really isn't such a negative environment. To me, it's a very exciting environment.
Jennifer, what do you think? Has the balance of power in your own world shifted away from OPEC?
I would say that there's just been a substantial change in oil production over the past 10 years. And, you know, to some extent, yes, the balance of power has shifted away from OPEC. I think I'm going to disagree a little bit on the demand side in that I think, you know, global demand was lower than expected. And that has influenced the current price environment. In addition, what's interesting to me is that the price of oil has been low for quite some time, and we're not seeing very much of a demand response to that, to the change, which I would arguably have, I thought we'd see more of a shift, more consumption of products, and to me it's fairly interesting that we're not seeing much growth in demand. I mean, who knows what 2016 will hold, but it's definitely an interesting environment.
I sat down with CPP when I was in Hong Kong, and the famous quote out of Mark Wiseman, who's CEO of CPP, is we don't think in quarters, we think in quarter centuries. So think about that. I'm not thinking about demand this quarter, next quarter. Think bigger than that, right? This is not going away. So prices came down and demand didn't come up, so what? The long-term demand is there. Everybody wants what we have, drive like we do, cars, you know, look at the growth of cars being sold in Asia right now. These things are not changing, they're not going away. They're building highways and cities all over the place. That's still happening. Is it the growth 7 or 4, whatever? So, you know, I don't know if we disagree, but I'll stand by the demand is there. We're in an oversupply situation. Run your business accordingly.
Why is it that we hear so much then about oil demand from China slowing down, which is one of the reasons supposedly that oil prices are so
As of April, they're the #1 importer of crude oil in the world. Where do you get slowing down from? I don't buy that. That's not what I saw when I was there.
I think an interesting point is expectations versus reality. So even though demand will continue to grow in China, the question is, will it continue to meet the expectations that perhaps the industry was pricing in 3 years ago?
The expectation's a good one. So we expected 7% growth forever instead of 4. This is silly, right? 4 is an amazing number. 3, 2, the absolute number in terms of growth, in terms of that market is massive.
Okay. Ranko, maybe you can expand a little bit on what is it that market players should be watching in terms of the oil market.
I think I'm going to say it again. I think the first thing is, in the short term, the first thing is what does OPEC do and what happens to North American production in response. I think that over the sort of 12-month horizon is the main thing to watch. So you look at completions, you look at production, and you look at fundamentally what is going to be the production of OPEC countries. In the medium term, I think the demand growth in emerging markets is probably the single biggest thing to watch for crude oil prices, because it's fairly well demonstrated. I think now it's well demonstrated that if you look at over the 10-year horizon, OPEC really is no longer a cartel. They do not determine supply over the 10-year horizon. It's demand that's going to determine production and price over that time frame.
Okay. What about, I just want to talk a little bit about Iran, because a lot of analysts are keeping an eye on Iran and all these barrels that are supposed to be stored in tankers and just ready to flood the market. Is that a big issue, especially over the winter?
Personally, I'd want to hear from the oil men about that. My take on the Iranian oil industry from sort of my own analysis of it, and the reading I've done, is that you have options for increasing production all over the world that are probably going to require a lot less investment and probably a lot less geopolitical risk, quite frankly, than going into Iran. It's not like we're running out of oil plays. They're everywhere. It's just a question of where they're the most cost efficient. So the question would be, will Iran be that place? Arguably not. But I would be very interested to hear.
Yeah, I just question the numbers, right? There's a headline number that's production that everybody's aware of, but the fact is their oil was still getting to market, whether or not it was hitting global markets, whether or not it was being taken by a merchant that was willing to take blood barrels per se and get them into Asia where there was true demand, or the Chinese were just lifting them kind of off the black market per se. The production was there, the capacity was there. So while the headline number might kind of ramp up and spook markets, I don't think it's going to distort true supply-demand balances.
Brian, just to follow up on that, you work for a producer. What are the strategies that you guys are using to take advantage of the situation?
Sure, yeah. Well, unfortunately or fortunately, I wear an investor relations hat as well, so there'll be a bit of a 7G plug here. Tim nailed it on the head. Balance sheet is crucial, okay? So you take a look at our company specifically. We financed twice over the last year and are sitting about $500 million worth of cash. We have an $850 million undrawn revolver. That puts our liquidity position at about $1.3 billion. It allows us to invest when prices and costs are a bit lower right now, so that we can grow into hopefully some appreciation in oil prices. We've coupled that also with adequate takeaway capacity. Transportation is key out of the basin, not just for oil, but with natural gas as well. Alberta is an oversupplied market, and if you don't have committed transportation, you can't sell your product and make money off of it. From a more macro perspective, I think cost is on the front of everyone's mind, right? As your top line revenue number comes down, if you want to still make a margin, you have to drive costs lower. And the industry right across the whole space has driven well costs lower, cut G&A to become more efficient to ensure that you can still make a margin from each barrel or each gigajoule of gas that you sell. I think from our perspective, we've been very active hedgers. That probably sounds a bit anomalous right now. Everyone's going, why would I sell the lows right now? But working kind of on a trading desk over the last 10 years, I remember when TI was trading at $100 and Cal 16 was trading at $80, and people were saying, why would I sell $80 crude when I can just let it float and receive $100 for it? Well, it's kind of trued up, right? And we're in this oversupply state, and everyone's drooling over an $80 print. So from some generations perspective, we've been very active hedgers to take out some of the volatility of our cash flows. You take a look at the shape of the futures curve, and it's in contango, so that means the forward prices are at a premium to the current or spot or nearby contracts. That means that we can lock in higher prices in the future than we can now. I think if you throw in the fact that the Canadian dollar is trading at about $1.33 right now, that means we can lock in $70 Canadian per barrel WTI for Cal 18. $70 for us means triple-digit IRRs on our investments right now. So we drill a well, they're paid out in under a year and essentially returning 100% half-cycle IRRs. So there is a compelling argument to be made to kind of continue to hedge, look for value down the curve, but you need to have an efficient business that can make money at those prices.
Okay. Just want to talk a little bit about how all of this is impacting currency. So we've seen the US dollar shoot up. How do you think you know, these low oil prices and so on, how are they affecting foreign exchange rates?
So I think starting with the loonie, has to be said that really it's got two primary drivers, interest rate differentials, which are intrinsically linked to monetary policy, so what the Fed's doing and what the Bank of Canada's doing, and obviously oil prices being the second primary driver. Now something that I think is worth noting is that over the last 10 years, oil has become increasingly financialized. So what I mean by that, I mean that spot prices are responding less to supply and demand. I'm not saying they're not responding, I'm saying that basically oil is behaving less like you know, perhaps copper or iron ore and more like a financial instrument. And I think maybe a controversial thing to say, but I think part of the reason why we had such an explosion in crude oil prices in the post-crisis era was very easy monetary policy. And I think the end of sort of the QE era, even though it's not coming to anytime soon, I think that will have an effect on the way that crude perhaps may return to more of a fundamentally driven spot price. So what does that mean for the Canadian dollar? Well, if we look at those two drivers that are sort of identified, interest rate differentials over the next year, 2 years, will certainly widen between Canada and the United States over the 2-year horizon. Price of crude oil, I would agree with what Tim said, downside is starting to look fairly limited. I think you know, we had those pops below $40 a barrel a couple of times this year. It was driven by fear, really. There were large risk-off events driven by what's happened in Asian markets and so on. So I think the downside risk in crude oil prices and therefore CAD is concentrated around those kind of you know, risk-off events that we've seen this year. So you have to look at what's happening in China. You know, will there be a credit event there? What's the capacity of the government to manage any sort of large-scale defaults? Those kinds of things. So there is downside risk for crude oil prices, even if in the medium term, you know, most people see stabilization, including myself. So for the Canadian dollar, even though those interest rate differentials will drive further weakness in the medium term, in the short term, you do see some risk for sharp retracement, especially you know, with how high expectations are for the Federal Reserve at the moment. You know, all markets are pricing hiking from the Fed at such an incredibly aggressive rate. You know, you do have to wonder, will they actually meet those expectations? And you know, is the dollar overbought coming into 2016? You have to ask yourself those things. Yeah, I'd be interested to get your thoughts, the room's thoughts, particularly on how much effect crude will continue to have.
Does anybody want to jump in? Comments, questions? Okay, let's talk a little bit about climate change and the big discussions that are going on in Paris. It's definitely yet another new world. We heard our former Bank of Canada Governor Mark Carney a few months ago was saying that this is going to affect a lot of the assets held by oil companies, and there's increasingly discussion here about the cap on oil sands emissions and whether that could impair a lot of assets. You know, when you reach that greenhouse gas emissions cap, well then what? You know, a lot of companies have big reserves and they're just going to write them down. So, Jennifer, you're following this quite closely. What do you think the impact is going to be of a deal, a global deal to reduce greenhouse gas emissions? Is it, you know, how is it going to impact potentially oil prices, fossil fuels generally?
So I think I'm going to be a bit of a pessimist and say that any deal in Paris probably won't affect anything at all. In that it's very hard to coordinate globally and to agree on targets, let alone policies for meeting targets. And so I don't see any broad impact. In terms of a cap on oil sands emissions, there's still a lot of room to grow, and the companies operating in the oil sands already have the incentive to reduce their emissions because it's reducing costs. And if I were an oil sands company, I'd be far more worried about the price of oil in the future than the new Alberta carbon tax or an agreement from Paris.
If I can just add that, just from the producer perspective, and maybe we're a bit unique, but we have 7 different stakeholders that we're trying to appease. One of which is shareholders, one of which is the government, one of which is the environment. So the fact that there's been this new climate control, this framework aimed at capping emissions, it forces us to be more responsible. So how are we completing our wells that can reduce flaring? Do we move away from nitrogen-based fracs to a natural gas-based frac or some sort of other hydrocarbon so that we can reduce our environmental footprint? That's really kind of fueling our discussion right now, because we want to fit in and work with the government and be supportive of their policies.
Just on the climate talks, something that I find quite interesting is that the reason there really hasn't been much progress in terms of limiting emissions globally, despite the weight of scientific evidence, trying to get into that, the reason there's any progress is fundamentally the deal that needs to be done is someone needs to reduce their emissions. There's political opposition in the West to reducing their emissions, so it's demand side really that they're trying to restrict oil supply seems to be particularly wrong-headed. It has to be, if you do anything about carbon emissions, it needs to be demand side. The problem with that is, you try to tell China or India, well, we've had our 150 years of carbon-driven growth, but you can't have yours. That's the problem. That's an awfully hard sell, when really, as Tim was saying, they have rising middle classes. They want to drive cars, they want lights, they want computers, and it's very difficult to make that trade-off on a global scale where Western leaders agree to reduce their emissions and give a little more leeway to emerging markets, especially because if we get a middle class develop in Asia over the next sort of 30 years, that's adding an extra 500 million to 1 billion consumers who consume the way we do in the West. And if their carbon emissions match those in the West, and the science seems to indicate that we have a serious problem. So there needs to be some sort of compromise. And the problem is that, as I said, fundamentally, emerging markets don't seem to be willing to say, well, fine, we won't develop.
Okay, so.
Can I add to that? I mean, in terms of Paris, it's a nice tax spend for our new Prime Minister to go shake hands. Good for him. I don't think it matters in terms of oil price long term. I think the statements Premier Notley made last Sunday matter, even in so much as now we've got some numbers on the table that we can all work around. But more importantly, what I think we did a poor job of in Alberta for the last decade is managing perception of how we deal with environmental issues. If you're a producer, you probably agree with me. We did a crappy job of it. If I go to New York on some meeting, people are still asking me about the tar sands. It's like, really? Come on. And so we did a bad job of that, and we needed to step up and be really forthright in terms of what our views are. This province has been aggressive and been a leader in terms of environmental aspects around production for a long time. We're one of the first top 5 oil producers in the world to have policy around this dating back to 2007. So this is nothing new in Alberta, but we need to manage that. Beyond Paris, I mean, the US is obviously a bigger issue for us as Albertans because 99% of our oil goes there. And so I'd mentioned this to Claudia because I'm always trying to figure out how do you comment on climate without being a prick and saying I don't care, because we do care, but we've always cared. And there was a statement out of the Council of Foreign Relations, and I'm going to read it to you. We use it in a piece that we just put out at Auspice about facts about the oil sands. So if you want to get access to that piece, give me your card after, or ask Dwayne who's in the room. But this was a statement by the Council of Foreign Relations urging U.S. policymakers to, quote, to resist the misuse of other U.S. environmental regulations to constrain oil sands. An ill-conceived regulation could undermine U.S. and Canadian climate and security goals. So let's be environmental. Let's have this in our policies, let's do the right thing, but let's be careful here, right? We've always been doing this. Safest place to get your oil, always had environmental regulations. Let's not get beat up anymore as a producing community, and let's get the right message out. And if it starts with Premiernopoly and putting a line in the sand, then kudos to her. But we as a community really need to get behind that we are doing the right thing. Producers like this have always been doing the right thing. It's not just lost on them. If you want to see the way oil shouldn't be produced, go to the Middle East, go to Nigeria, go to Russia, and you'll get a real eye-opener.
Yeah. I think it's going to be interesting to see what happens in the United States in response to the carbon price that we put here in Alberta.
We'll see what Donald Trump does about it.
That's right. Okay, let's talk a little bit about gas prices that are just dismal. What could change here, and also perhaps we could expand a bit on the new climate policy, because there is a component of the Alberta climate policy that should be beneficial to gas demand, right? So Jennifer, again, you've been following this. What's your view?
So, for some reason, the Notley government has decided to phase out coal by 2030. I think maybe a smarter policy direction would have been to say coal should be as good as gas by 2030. That said, they have indicated that they want to have a lot of the coal generation replaced by renewables. Wind blows 30% of the time. We're pretty far north. There isn't much daylight in the winter, and so solar isn't such a great option for us. And that means that a lot of capacity is going to come from gas. It'll have to, unless we expand intertie capacity between Alberta and BC and try to access some of their hydro resources. But I think that the climate policy announcements are really bad for coal producers and probably fairly good for gas producers in Alberta.
Brian, what's your view?
Yeah, you know what? We've been doing some research and some kind of competitive analysis with some of our peers in the U.S. that have analogous plays to our Montney play. You take a look at some of the wells that are being drilled down in the Marcellus and the Utica. It was EQT that a couple months ago announced a 70 million cubic feet a day well. That's one single well. These are massive wells. So there's no doubt in my mind that there's hundreds and hundreds of years of gas resource within the continent alone. So that's kind of the supply side. To get constructive on price, I think the market always has an ability to surprise us. I think the obvious trade right now is to be short natural gas because of the wells and the prolific resources that we keep discovering month after month. But whether or not it's a weather event, another polar vortex, that'd be polar vortex number 3 would it be, or a change in regulatory because there's earthquakes in Oklahoma or things like that. That's something that might kind of catch the market off guard, squeeze the shorts, and we see some price appreciation here. I think it's forced producers to become more economic. We've always prided ourselves on being some of the lowest cost supplies so that you can be called to market and still make a margin in the lower price environment. As I said before, transportation is key. There's resource everywhere. It's how do you get it to market efficiently? So the fact that we've stepped up for about half a BCF of Alliance capacity over the next 3 years means that we can get our gas out of Alberta, which is an oversupplied market, to Chicago, where there is actual demand for the product, and we can realize a better price for it. Just kind of echoing Dr. Winter's comments on demand domestically here in Alberta, the fact that we're going to phase out coal demand or coal-fired power generation is constructive for the gas industry. We all know that wind is super volatile. The wind's blowing or it's not. When it's minus 30 and there is a big demand for power, guess what? The wind isn't blowing, so we need gas-fired generation to kind of replace that chunk of the power generation stack.
So we're saying though that the climate policies are bad for coal, but shouldn't they be? I mean, if you're going to squeeze anything, squeeze coal, and we don't disagree with that. It is supportive for gas, and given the oversupply situation that we all know is there long term, there's gas till forever. I think it becomes about how does a company like Seven Generations or any producer have an efficiency in that space and a longevity that's what it's going to be about. The high-flying days of natural gas are done, and run your company efficiently. Hey, it was mentioned earlier, the curve's in, if the curve's in contango, be short, take the contango, and move on. And you got to be there for the long term. But it should be supportive for natural gas long term. And so I commend the policy 100%.
We've talked a lot about new markets for oil, but what about for gas? Is anybody still counting on LNG projects taking off in BC?
It used to be called the crown jewel when I was at Shell. I left about 10 years ago. I don't know if they call it the crown jewel anymore.
Yeah, just to kind of comment on that, we've obviously got a ton of resource and we're trying to figure out what the most efficient market is. We've taken a look at LNG and the economics. I struggle to wrap my head around the economics to build a pipeline, to build the gasification capacity, the liquefaction capacity, and get it onto the water. But interestingly enough, I was over in Tokyo 2 weeks ago speaking with an LNG purchaser, and his motivations were not primarily economic. There was diversity of supply.
Yeah.
So if he has to pay a couple bucks more to get gas out of Canada, that's going to be there day in and day out and not worry about Qatar or some other jurisdiction cutting supply or the Russians turning off the pipeline or an LNG supply, that trumped economics from his perspective because they need the lights on.
It's such a critical point. Whether it's oil or gas, it's the world wants what we have. We're sitting here on the third largest reserve in the world. We got lots of gas. The world wants what we have. It's about getting the best price for our commodity and not be beholden to Big Brother. That's what matters here. We can argue about OPEC and currencies and all these things, but at the end of the day, what's going to matter is what's that price you're going to get for your barrel or your gas, because at the end of the day, that's what matters. Right? Like, we're a non-fundamental trader. I can debate the fundamentals all day long, but if crude goes up by 50% and I'm not making money for my investors, they don't care what OPEC did. They care that I didn't make money for my investors. My job is to follow the price. And at the end of the day, that's what rules.
Ranko, big picture, macro, what are some of the things that you're watching?
I was discussing this with Jennifer earlier. I think the first point you've got to make about global macro is that, and you can see this really in the Canadian economy, is that it's very slow, sluggish. The economy hasn't grown as fast as we expected to in the post-recessionary period. And you talk about Stephen Hollis, for example, saying he was mystified by how sluggish Canadian exports have been, considering the weakness that we've seen in the loonie. Well, should be mystified. You see the same thing in even the other G10 economies that are performing reasonably well. External demand is incredibly weak. So we see the same thing in the UK, and I think that will be the big story of 2016, is that external demand will probably be weaker than a lot of people are expecting. And that's not just the sugar slowdown in Asia. We've got the US really, although and the US remains the most important source of external demand for Canada, of course, not just for energy, but everything. It's growing either on trend or slightly below trend. And that's not really what you'd expect considering how loose monetary policy has been over the last 5 years. So something's going on. You've got the secular stagnation hypothesis, which may or may not turn out to be the case. This idea that Western economies really have shifted down the gear. Productivity growth is lower than it has been in the past, and that'll continue to be the case. Or ultimately, it could just be still distortions from the crisis. So I think the big thing in 2016 will be that external demand will continue to be weak, and it's how monetary and fiscal policy responds to that. Fiscal policy in particular, I think, will be quite interesting. So Canada's government, now new government, appears to be doing something that's actually very important, I think, in terms of acknowledging that fiscal policy has been unnecessarily tight in the post-recessionary period. And I think jurisdictions like Germany and the United Kingdom in particular should take note of that. You don't have to tighten the fiscal purse strings as much as you have done over the last 5 years. If markets will keep cutting your deficit, you can maintain spending where it is. You can even increase it. And government debt as a percentage of GDP isn't necessarily going to get out of control. So I think it's very promising what Trudeau is promising to do on the fiscal front. On the regulatory front, it's a question mark.
Jennifer, you're the other economist in the room. What are some of the big things that you are watching for?
So I'll be watching Russia and Europe with interest. I think if Putin keeps doing, I'll call it crazy things, it could actually make a case for LNG from the East Coast, in that Europe may just be looking for someone who is a stable supplier that isn't going to have temper tantrums, essentially. In terms of internally, something I'm going to be watching is changes to the NEB, in that Justin Trudeau and various members of the Liberal Party have indicated that they're not happy with the changes made to the NEB Act by the Harper government. They've been talking a lot about social license, public acceptance, and I think it'll be interesting to see whether or not investment in oil and gas in Canada and in pipelines changes in response to potential changes to the NEB Act, combined with the changes to the rules regarding foreign investment. If there is a, let's call it an additional slowdown in foreign capital investment in oil and gas in Canada.
Okay. Are there any questions out there from our panelists?
I'll go back to touch a little bit on it during the discussion. As Tim said, I mean, it's very important to get the best price for the product. But it's not necessarily related to the global pricing of oil. I remember that 10 years ago, one of the CEOs of a major company in Calgary said this: we need market access at $20 a barrel. We need market access at $120 a barrel. Fast forward 10 years, we're still talking about market access.
Yeah, exactly.
And my theory is in 10 years, we're going to still talk about market access. And I hope that's not the case, and for the good reasons. Maybe we solve that one. My theory is if you don't get the market access, I mean, it's the investment will go in jurisdictions where there is market access, right? And I will put an analogy here. I mean, it's shipping oil by train. Is that the most efficient? I don't know. I mean, it's what would happen if you ask a farmer to ship their cattle old style by horseback, and not by a freezer in a train or in a truck. So what do you see the major barriers in solving this issue for us? Is it economics? Is it, I don't know, as you said, social license? Is it political will? Is it environmental concerns? Public acceptance? What is it?
Yes.
What do we need to solve in order to get this stuff done?
It's all of those
compared to
things.
Russia or China, I mean, if they want to build a pipeline, they will build it with a T-72 front end.
Yeah, true. And one of my biggest takeaways from today, and then I'm going to dive right into your answer, is what Brian said, and that's the diversity of supply and that stability of supply, and maybe beyond the economics for that market, they're looking for our commodity. And so, your statement, 10 years from now, we're going to be in the same place where we don't have that market access. Listen, I'm not a producer. I'm an advocate. I'm a hedge fund manager, but I'm pissed off, and I'm doing everything I can to create that access. I walked into the Hong Kong exchange about 2 weeks ago. They knew exactly who we were. They want our Canadian crude oil ETF on their exchange because they believe there's China and mainland investors that want to trade our crude. That blew me away that they even knew who we were or what we were doing, but they're absolutely aware. So that has to have political effort behind it, and this is not a political statement. I'm quite agnostic, actually, but about 2 weeks before I was there, and I think you were in the same area, our energy minister, Margaret McCaig-Boyd, was over there. And that was her takeaway that the government officials told me as well. It's here, the demand is here, that need for diversity of supply is here. We need to make sure this happens. Now, whether the Notley government can help that, I don't know. But it appears that they're willing to listen. And if I back up a few years ago, and this is probably a political statement, is nobody seemed to care, right? And again, we believe to get a fair price for our barrel, we need not only physical logistic access, we need financial access. You said it many times, WTI is a financial instrument. WCS and Canadian oil is physical, traded in a little bit of a pool, and it goes around and around in a circle. We don't let anybody else have access to it. It's a bit of a generalization, but it's not far off the mark. If I go to Dubai and I talk to them about Canadian oil, the third largest supply in the world, they're like, how do I trade that? Well, it's physical. So they got to, get involved in the physical game. They're not going to do it. So we're trying to do those things. I'm very motivated to do those things. Yes, I have a bit of a stake in the game in that I have a crude ETF, but I guarantee what I get paid on that crude ETF is a pittance compared to what my peers in the producer community are going to gain. If we can somehow gain that access and narrow that spread, because the world wants what we have, not necessarily because of the price issue, but because of that diversity of supplies. That's my biggest takeaway from today. And there's a lot of people motivated to solve what you're talking about right now.
And if I could just add to that, I think you make a really good point. Social license, right? We've seen various pipeline companies who are great companies, but come in and go, here's what we're going to do. Here's what we're going to put in the pipeline. You guys in? You want a bit more money? Are you in? Right? Like we've got a very, very large project just an hour south of the Grand Prairie community. It's on traditional native land, and we've taken the approach that we're going to sit down with the native community or the First Nations and say, here's what we're thinking. What do you guys think? Where's their sacred land? How can we incorporate the migratory patterns of animals? And what's your view? Like, buy into it, buy into the program. We'll work with you. We'll employ your company so that you're benefiting from it as well. And all of a sudden, we have the community's buy-in that we're working together. We're not working against each other. And that social license component has been a huge game changer for 7 generations up in the Montney. And I think that kind of translates into the transportation argument as well, right? We need to work together to come up with a solution that benefits everybody.
Or we just add more train cars down the rail line. That'll solve everything.
Well, my view is that we need politicians to lead. I believe that the easy part was the climate change stuff because it involves taxing people more. The hard part, the heavy lifting, is to deliver the other part of the promise, which is market access. And that's going to require politicians to deal with First Nations, to deal with NIMBYs, to deal with environmental organizations, to deal with a lot of premiers who got their hands up. And let's see what they come up with. So it's tough. It's really tough. I mean, I've been covering it for 10 years, and I'm sick and tired of it.
One option is we just move to Saskatchewan because Bradwell's open for business.
That's the option. Anyway, I think we are out of time, and I'd like to thank our panelists for joining us today for a very insightful conversation. Thank you.
Yes, thank you. And just thanks again from the Chamber of Commerce for joining us earlier this morning, and a big thank you to our panel. You folks were fantastic. I learned a lot. I understood about half of it, but that's an improvement for me. So Tim, Brian, Jennifer, Ranko, Claudia, thank you very much. Neil as well. Nelson, just a couple last points. This event today was supported by our great event supporter Purdy's, and so for all of you folks that took time out of your day to speak to us, we have a big bag of chocolate for you. So, the pay for these events is great, let me tell you. And another big thank you to our event supporter, Daniel Creasy, who's at the back. This really would have been possible without him. If you talked to a guy on the phone with an English accent who was really friendly, most likely it was Daniel. So thanks a lot for making it possible. A couple of the key themes today that bubbled through, there were a number of them, but certainly climate change policy was one of them, and certainly another one was social license. And so in that regard, I'd just like to highlight for you another upcoming event that we have. It's a week today on next Wednesday, but it's in the evening. We have the author of the climate change policy framework. Dr. Andrew Leach is doing sort of his first kind of public speaking engagement. It's not early in the morning, it's actually after work at a gin joint, so we can all go there for a drink and ask some hard questions of Dr. Leach about what it means for Alberta and what it means for social license. I'd invite you all to join me there. It's a pretty exclusive event, just a few tickets remain. So thanks very much and enjoy the balance of your day.